Welcome to RFI's Banking Uncovered, the podcast going behind the industry PR, the media spin, the product awards, and the investor reports to look at what's really going on in the customer data, and to ask global thought leaders about their thoughts and views on the future of banking and payments.
Welcome to RFI's Banking Uncovered, where this episode I'm delighted to welcome back Stefano Colombo. Stefano is our Managing Director for RFI Asia. So welcome back, Stefano, and look forward to chatting.
Hi, Charlie. Thank you so much. Happy to be back here with you.
Fantastic. Well, let's jump straight in. Obviously, you're based in Singapore. Singapore is a huge regional hub for banking and for wealth. It's also an incredibly developed and dynamic market, both from creating wealth value propositions and also from a digital point of view. So we know there's a lot going on in Singapore at the moment, and we know from our latest share of wallet tracker that the average mass affluent Singaporean holds about 700,000 Singapore dollars in their wallet. So tell me a bit more about what's going on in the market and where that data comes from, what it means.
Thank you, Charlie. Yes, you are exactly right. We see two factors at play in Singapore. The market is highly vibrant and also highly fragmented. It's vibrant because we see the rise of the fintechs, the digital-only players, progressively gaining market share and penetration. And it's fragmented because the Singapore customer, particularly the affluent customer, they tend to diversify their banking relationships. They tend to bank with multiple providers, and each provider satisfies different needs of these customers. In our share of wallet, we have seen that on average, the affluent customers here hold around 700,000 Singapore dollars in assets under management. Where it's very interesting and where the opportunity lies for banks is also in understanding the difference between the affluent customers versus, for instance, the emerging affluent, because as they grow their wealth, their AUM scales up more than 7 times. So this is quite a large segment in the market, and a segment that is particularly wealthy, which is ripe for the banks.
Okay, and what else happens as customers age? Do they consolidate? What's the average number of relationships they have? Does that increase with levels of affluence? What are some of the differences that we see there?
Yes, we see that as they age, they still remain pretty much wealthy. There is a level of consolidation, but they still maintain a large number of relationships. They are just below 3 for the group 55 plus. We are just above 3 for the 44, 55 plus. So there is a little bit of consolidation happening, although even as they age, they do two things happen. They retain more wealth, and they still maintain active relationships with banks, with still a large number of banks.
Okay, so they've obviously got multiple relationships. So let's go two questions first. So if we look at the market overall, then the domestic players, DBS, UOB, OCBC, POSB, they all do very well. I think they have about 51% of wallet share. But then when we move to the mass affluent segments, we see that it's the international players, HSBC, Standard Chartered and Citi, that are doing well with about 30% of wallet share. So what are some of the ways that that banks can drive greater wallet share, and what are some of the tools at their disposal?
Yes, Charlie, that's also very much true. We see this dynamic at play. We see that the local banks, the like of DBS, UOB, OCBC, at the total market level, they capture a larger wallet share. We are looking around 50%, while the international banks, they kind of lag behind. They only have 20% of the total market. The picture does change when we look at the affluent customers. The local banks, they still remain quite competitive. They still manage around 40% of the wallet share, but we see the international banks, the like of Standard Chartered, Citi, HSBC, growing in wallet share. We think one of the ways to really try to understand what is driving this shift as we move from the total market to the mass affluent is for us to look at some of the CX metrics, the NPS score, for instance. And what our data is telling us is that when we look at some of the key segments, the main bank relationship, the priority banking relationship, but also the channels, for instance, the importance of DRM, we see that the international banks, they do gather higher NPS scores compared to the domestic banks with the mass affluent. So we think that there is a slightly better, a slightly more positive customer experience that the international banks are able to deliver to their affluent customers.
I'll come back to each of those three pathways individually in a second, but you said something just there about there's a better customer experience at the mass affluent end of the market being provided by some of the international banks. And you mentioned relationship managers, which throws up the never-ending conundrum of the relationship manager model, the human model effectively, and the increasingly digital model we're seeing at the moment. So where does Singaporeans, mass affluent Singaporeans sit with their relationship managers? Is it a big driver of satisfaction? Is it something that banks need to focus on? Do they want to be more focused on digital things? What are some of your thoughts around that?
I think in Singapore we are a little bit in between. We see relationship managers still being very much important. We see customers showing some degrees of satisfaction also in their quality of the advice, but we see also the importance of the digital channels. When we look at the interaction of across all the channels, we see digital is the one that is growing the fastest. Particularly among the affluent, something that we continue to share with our clients is the importance of understanding the very nature of the affluent consumers. They are assets rich, they are money rich, but they're time poor. Hence the importance of delivering those experiences, those advice, the ability to provide transaction, to monitor their accounts, to manage their investments through the mobile banking app, and then rely on the physical channel, on the RM, for instance, when it comes to more delicate, to more sophisticated conversation.
Okay, we can't talk as digital these days without talking about AI and Gen AI. So we know from the data, from RFI's data, that when and obviously there's a huge amount of cybersecurity and financial fraud in every market, growing hugely at the moment and exponentially, unfortunately, and Singapore is no exception. So when you ask mass affluent consumers about their views on AI, they want to use AI for fraud prevention. And they want to use it for advice, and obviously that lends into what you're saying about being time poor. But at the same time, they have concerns around security and around the quality of advice, which is the exact same two things that they want to use AI for. So it's kind of a slightly contradictory conundrum. So what are your thoughts on how banks can be bringing AI into the digital human value proposition when we look at mass affluent wealth?
It's a very good question, Charlie. And I think the importance here is really in the ability of the banks to try to strike a balance. There is definitely a series of tasks, a series of actions that are performed, which are more transactional. And that is where probably there might be as much higher opportunity for AI, Gen AI, to deliver some of the solutions that consumers are expecting. And the other part which still required some human touch, human intervention, and a slightly more elevated level of security to be delivered to the consumer. So when we look at the data, we see, as you said, there is a certain degree of comfort coming out from the market, but it is really important for banks to be able to strike the right balance. And we think looking at those transactional first experiences might be a good way to start for them.
I want to come back to the three pathways you mentioned earlier now. So the first pathway was obviously converting deposits into investments, and there's a huge amount of money sitting there. So we know from the tracker, I think about 70% of wealth is sitting in low yield deposits. So obviously that's a big opportunity for the banks. But talk to me some more about that and what they can do about it.
Yes, Charlie, you're absolutely right. There is a large amount of AUM sitting in deposit. This was quite eye-opening also for us when we first look at the share of wallet data. We see that roughly 70% of those 700,000 Singapore dollars in assets under management is sitting in deposits. We see a few things. First of all, we see that the likes of Standard Chartered and DBS are the best bank in capturing the deposit, in retaining the deposit value of their customers. We also see that there are some tailwinds, two in particular. The first one is connected to the interest rate. Interest rates are going down, and these will trigger consumers into moving some of their savings into investment products. Banks need to be wary though. Consumers have different triggers when it comes to taking up new investment products, but there are also certain barriers that banks need to overcome. Understanding the triggers is important. For instance, consumers are looking for personalized advice. They're looking for higher returns on their investments. In terms of the barriers, and these are the ones that needs to be addressed, there are time constraints, as we said before. They are particularly the affluent customer. They are asset rich but time poor. There are consumers who express concern about the volatility of the investments, and also, as we said, a preference for safety.
We've been talking a lot about the affluent consumer, but actually there are two types of affluent consumer. There's the domestic mass affluent consumer, and there's the cross-border mass affluent consumer. And when we talk about the mass affluent consumers, and they're asset rich and time poor, and they're demanding and they want personalized services. I suspect that's even more so the case with the cross-border mass affluent consumers. So yeah, it makes up a huge amount of the market. I think 45% of all AUM is cross-border and held offshore. So what are some of the trends that we're seeing in that cross-border space, and what are some of the differences in the usage and behaviors and satisfaction levels of the cross-border mass affluent consumers?
Yes, Charlie. Again, this is a very interesting question, and something that at times banks also struggle to have a full visibility on their customers across the border. When it comes to the cross-border banking relationship, there are two dimensions. There is a dimension of customer base out of Singapore and sending money overseas and making investments overseas. And then there is the relationship, the dimension of customers sitting outside Singapore and making investment, sending money into Singapore. In both ways, Singapore is very well positioned because when it comes to offshore investment entering into Singapore, we see that there are two key drivers, two key corridors here. There is the ASEAN corridor. So there are investments coming from the ASEAN countries, the likes of Malaysia, Indonesia, Thailand, for instance, where Singapore, again, it's emerging more and more as a wealth hub for affluent consumers based out of these geographies. And then there is the other layer, which is driven by the giants in Asia, the likes of India and China. Also there we see affluent consumers investing more and more into Singapore. And again, this presents an opportunity for banks to capitalize on. The other dimension is Singapore customers themselves making investments, sending money overseas. And also there we see some of the key corridors emerging very clearly. Of course, there is the strong relationships that Singapore has with Malaysia, and Malaysia does remain one of the most important cross-border corridors for Singaporeans, but also the US and China are becoming, US remaining and China becoming even more a strong and important corridor for Singapore cross-border banking customer. It's quite interesting because also that when we look at the data, we found it very surprising to see how much money is sitting from Singapore affluent customer is sitting outside Singapore. It sits around 45% of the total AUM. So these, again, are consumers who are quite international. They have a significant part of the AUM also sitting outside our jurisdiction, the domestic jurisdiction of Singapore. Affluent consumers are interesting for a set of reasons, particularly those who are cross-border banking customer. First of all, they are more savvy with their banks. They engage more. They show much higher appetite for products. Some of the metrics that we capture in our study is the appetite to take up new products. There is a 10-12% delta in favor of the cross-border banking customer when it comes to take up new banking products. And they also express different pain points, different annoyances with their bank, particularly when it comes to digital banking and the RM. And this is where, again, they want their banks to provide more delightful experiences because, again, they engage more across these channels.
Staying with cross-border mass affluent consumers at the moment. So obviously they're more engaged, they're going to invest more, but they're less satisfied with the channels available. Where does the relationship manager sit with them? Is that something that's the same as the domestic mass affluent consumer, or are they more engaged with the relationship manager model, less engaged? What are they looking for in that space?
They're definitely more engaged as they're more engaged across the digital channels. And what they expect from, particularly from the relationship manager, is to be more proactive. They want the RM to interact more frequently with them because, again, being cross-border banking customer, having needs across different jurisdictions, and probably using the same bank also across the border, they would like to have a single point of contact. Hence, these pain points that we capture around proactiveness of the RM.
Okay, so we've spoken about two of the pathways now that banks can look to in order to grow their share of wallet amongst their customer base. So I just want to touch on the third one now, which is the non-bank sector, which is obviously a mixture of has been growing considerably over the last few years. I think they now capture about 39% of the mass affluent base. So what are some of the other things that we're seeing in the data around that? And more importantly, how can banks start to recapture some of that money that's leaking to the non-bank sector at the moment?
Yeah, Charlie, that's absolutely right. Again, that's a very valid point. When we look at the share of investments within the wallet of affluent consumers, we see that around 39% of the investment value it's deployed, it's held with non-banks. And Also, there are some interesting dynamics. We see that, for instance, the domestic banks are those who are leaking more towards the non-banks. OCBC, for instance, top the rank in terms of leakages to non-banks. They lose around 120,000 Singapore dollars to the non-banks. Um, we see that the way for banks to compete with the non-banks are particularly around the quality of their advisory services, the ability to provide integrated services also across all the investment products, and to provide innovative features. This is where the competition with banks and non-banks is kind of eating up here in Singapore.
And why? So you said OCBC and the domestic banks in general are leaking the most to the non-banking sector. Is it just the quality of advice? What are some of the drivers that you're seeing in the market around that shift?
I think it's a combination of a few elements here. For instance, as we've seen also before, we see that the non-banks, we see that domestic banks, they kind of lag behind when it comes to NPS, particularly for NPS across important metrics, the priority banking. So there might be some gaps that affluent consumers are unable to find through the traditional banks, the domestic banks, and hence they rely to their non-banks partner. There is the element of innovation, as I said, particularly when it comes to the fintechs. The fintechs, even though they're capturing a small wallet share, they are growing and they're biting mostly across these domestic banks. And then also it's a matter of choice. We know that in Southeast Asia, in particular, insurance is often seen as an investment vehicle, and the insurance providers are also capturing a large share of wallet from the affluent consumers.
So you mentioned fintechs there. I just want to touch on those for a second. So back in 2015 in the UK, I think 2 to 3% of the population had used a digital only player or a fintech. That's now grown to 54% in 2025. Slightly more alarmingly is because that's just, have you used it at all? When we look at the acquisition of new main bank customers over the last 3 years, the fintechs, Monzo, Starling, and Revolut in the UK have acquired 25% of new main bank customers over the last 3 years. And in the US, SoFi and Chime and the other fintech startups there have acquired almost 30% of new main bank customers over the last 3 years. So some pretty scary statistics in the US and in the UK. In Singapore, total usage of fintechs is only around 15-16% at the moment, and it's pretty similar in Hong Kong at the moment. Do you think we're going to see a trajectory like we've seen in the UK and the US, and banks need to be concerned about that, or are there other local, regulatory and landscape factors that mean it's not going to be quite such the numbers that we've seen in the UK and US markets?
It's an interesting question, Charlie. I think what we should be looking at is the momentum. And when we look at the data, we've seen how fast the likes of Trust Bank, Maribank have been growing in the market. And these players have been able not only to grow fast and acquire, be very good in customer acquisition, but also in deploying innovative products. And this is something that, in my view, sitting here in Singapore and looking how players are deploying different solutions across the market, it's something that would drive adoption. For instance, Maribank recently launched a new investment proposition, which is quite competitive, it's quite comprehensive, and it's gaining traction in the market. Again, it is a digital-only bank, but again, they're trying to play in a slightly different field compared to the traditional digital banks. They're not only trying to drive acquisition through CASAs or promotions, they're also diversifying into investment, and these investment products is gaining traction and support in the market. So when we look at the momentum, when we look at the data in our studies, we see that digital banks are growing fast. We also see that they're diversifying their offering, and although we are still probably far from what you are able to see in the West, we see that this momentum might result in a similar success for the digital banks also in Asia.
Okay, just to come back to Singapore for a second and to wealth. So You said earlier that that interest rates are coming down, therefore more and more mass affluent consumers are taking their money out of deposits and putting it into investment products. And when we look at that globally, we can see really, really significant investment appetites for 2026. And when we look at which markets are there, whereas the highest amount of investment appetite, Singapore, Hong Kong, and Taiwan are the three markets globally where there is the highest amount of investment appetite amongst mass affluent consumers. So obviously, a really exciting year ahead in 2026 for everyone working in wealth management in Singapore. But if you had to step back and and look at the landscape and look at the data and what we're seeing, what are the main takeaways that you would highlight for any wealth managers that are listening today that they should be thinking about for 2026 and beyond?
Well, definitely we see this trend coming. I mean, rates going down. We expect consumers to even be more aggressive when it comes to investment products. There are some themes which are also global themes, right? When we look at the appetite for different products, we see in Asia much higher appetite for local share and equities. There is a vision to sort of diversify from North America, particularly the effect on the dollar, for instance. The fact that the dollar is devaluating is motivating some of these investors to look more aggressively into these Asian markets. And Asian markets offer quite attractive valuation, particularly when we look at the equities market here. There is a strong trend around gold. Again, this is a global trend, but it's something that is happening also in Asia, and we see it in our data as well. We see how much the appetite for gold and the holding of gold is increasing across the markets in our studies. And then again, what wealth managers should be looking at is particularly these tailwinds that we have highlighted. With rates going down, there is a much higher appetite for consumers to diversify and taking up new investment products, and there is a huge amount of assets sitting in deposit, which is ripe for conversion.
So if you're a bank, what do you need to focus on? Like, is it your legacy strengths? Is it competing on digital? What's the thing that you need to focus on right now to make sure that you're growing your share of wallet amongst your customers?
Again, it's a very good question. I think it really depends. When we look at different segments in the market, there are some specifics which are relevant at the segment level. For instance, wealth transfer is becoming quite important here in Asia as the population ages. There is a lot of AUM sitting with all generation that it's being transferred to the younger generation, and there is an opportunity for particularly the new entrants to capitalize and design solutions which are targeting the younger generation so that they can deploy the funds toward this new solution. Here, the incumbent needs to design, to deliver these new solutions, this new platform in order for them to be able to capture these flows. And then there are certain themes that they really cut across all the segments and the different generations. And it's one that we've been discussing since the beginning of these episodes today, is the importance of the digital channels. This is something that is important for all the segments, for all the different age groups, particularly when it comes to the affluent segment.
So getting that balance between the digital and the human, and getting the perfect balance and a personalized balance for the mass affluent segment.
Absolutely.
Fantastic. Stefano, thank you very much for your time. That's been really, really interesting and insightful, and look forward to talking again soon. So thank you very much for joining us.
Thank you so much for having me, Charlie.